Chris Gerardi is an entrepreneur and the visionary founder of Realbricks, an innovative platform designed to make real estate investing accessible to everyone. With 17 years of operational experience at multiple public companies, Chris has honed his expertise in building teams and executing high-level operations. His mission with Realbricks stems from a desire to empower individuals, especially young adults, to overcome traditional barriers to real estate investment. By promoting fractional ownership, Chris aims to equip aspiring investors with the tools they need to navigate the evolving landscape of personal finance, unlocking their potential to build lasting wealth. What's up, my financially intentional people? I'm super excited to be joined by Chris Gerardi, and we're going to talk about one of your favorite subjects, real estate, but from a different lens and a different approach to real estate. And I'll let Chris explain it, but I think the real estate space can be a scary place or one of those places that a lot of people jump into blindly because they think that they need to own a house. But I want people to know that there are different avenues to home ownership or using real estate as an investment class. So welcome, Chris, to the Financially Intentional Podcast. So happy to have you.
Hey, I appreciate you having me on. Thank you. Thank you for taking the time.
Cool. So let's just hop into it. What is Realbricks and what is your approach to real estate investing? Or is it real estate investing?
Yeah. It started off about 4 years ago for me. It was a lead in from, I've always been into stocks, stuff like that from a very young age. I think obviously I wasn't 13 years old when I did my first stock trade, but I was 19.
You know what? I've had people on here as young as 9 and 12 that have had bought into stocks.
My son is 9 years old or just turned 10, and I let him help pick my stock picks on my Robinhood app.
Nice.
And so it was always interesting from an early age, the way these things work, markets and such. But basically what happened was the alternative asset class of crypto and stuff came out. I started doing a lot more research in probably late 2014. And that's when I got involved there. And I looked at it and I said, man, wouldn't it be amazing if you could have a digital portfolio that's super simple to use, accessibility with low barriers that is connected to a tangible asset? Because one of the things that always was in the back of my mind was like, I know that I'm not to hit on too hard of punches on alternative asset classes, but things that can be easily controlled can be easily manipulated. Mm-hmm. And so I knew that. I've known that for a long time. And so I was like, maybe there's a way to do this with real estate so that way people can be connected to a tangible asset that's legal, that's compliant through the SEC. Obviously, there's a lot of regulation to get there. But also at the same time, be able to invest in and sell out when they feel the need. Most of the funds that you get involved in that maybe you can do online, there's a few of them, but you're getting into a fund. So you don't necessarily know exactly what every aspect is, but also your path, if you want to sell later, is a manual process. Like it, most of it's going to take time, and there's certain terms you got to follow. There may be early exit fees, stuff like that, right? And that doesn't really work for the average everyday person. I think it's very different for the average everyday person because the average everyday person doesn't have necessarily a very, very heavy, large nest egg, right? So once again, I do believe that you have to be disciplined to invest. And the first step is always to take action, no matter what, whether it's $10 or a million, 10 million. Point being is not everybody has that ability. So it's very easy when you hear people get on TV, CNBC, and they go, I invested in this and I'm in it for the next 10 years or 7 years. And great, that sounds great. It sounds great if you're selling it on a roadshow, but that's not reality. Most people can't wrap up their money into assets and sit on them for 10 years. It's just not the reality that we live in. And it's not a reality because we have a government that loves to print money, and the cost of inflation. At the end of the day, in 5 and 10 year spans, a lot of stuff happens. And some of those things can be positive and some of those things can be very negative, depending on what your Fed decides to do. And so with that, I created Realbricks, and it's been a long haul. We just launched. It's take a lot of time to get through regulation. It took an immense amount of time to create the platform and the tech to where it's compliant and follows the protocols that are needed. And also with that, it has a secondary trading or system in it. So that way people can sell their assets to one another in a marketplace, which has not been done before as far as the real estate piece goes like this. And so that was really a big piece of it for me. Was I looked at it and I was like, okay, how do we do this and do it right for our consumers, for the customer? Because once again, you get lost in all the mumbo jumbo stuff and you forget about the customer. And that happens in companies all the time. And if you can remember the customer, then you'll probably do well. So I was like, okay, we need to have an easy enter, right? Swipe, you pick your asset. Single family homes to start with, they're simpler to understand. We got to get mass adoption. We need people to understand. And so there's a pathway to that understanding. That pathway is not some super complex asset that they can't figure out, right? It needs to be very simple. Homes that they see in the neighborhoods that they live in. Okay, I see this home, I pick it, I look at the APY or the return, the estimated return, and I swipe up and I'm an investor. Literally that simple. It literally takes that long. And then when it's fully funded, so when it meets the minimum threshold of funding, then it will be placed on the marketplace and then people can sell and transact with it. Maybe they hold on to it for 3 years, maybe they sell it. But with that said, as long as they hold on to it, they're going to get a percentage of the net revenues from the renters back.
Okay, so to break that down into a little bit more simple terms. So say there's a house on my block for sale. As a matter of fact, the house across the street just sold. So we would go into it, me, Chris, a couple other people will go into buying the property together, and then we would rent out the property and share in the returns from the rental. And then maybe later on down the line, be able to sell the property for a profit.
Yeah, but it would be you and maybe 1,000 other people.
Okay.
And you don't have to worry about any of the renting or any of it. So how it works, so yes, you broke it down. It works just like that.
Yeah.
But the key component is you are a legal owner in the interest of that asset, but you don't have to manage that asset because we have a management team that manages it for you. And then what happens is those net returns get distributed right into your portfolio. And so every quarter, your return shows up in your portfolio. You can transfer it to your bank account. You can reinvest it. You can let it sit there. You decide.
What is the minimum buy-in for your projects?
$100.
Love it. I love it.
$100 is the minimum buy-in for the primary markets. When the assets start to go to the secondary market, those minimum buy-ins could be $3. They could be $20. They could be $19. And you can buy one, or you can buy 10, or you can buy 100, whatever you want to.
Can you explain the difference between primary and secondary market?
Yep. So why there is reason why you should get it in the primary markets is, so say we bought home 1234 Realbricks Avenue, and we paid this actually has happened. We bought a property, we paid $385,000 for that property. Obviously, there's some fees and stuff that go into that when we bring it to our consumers. But essentially, that property just was valued at between 425 and 400, and the comps were 425 to 430,000 bucks. That's a little over a year later. And so you get to get in basically early. It's similar to a company if it IPOs, right? You get to get in, you get to hold on to it. When the shares appreciate, you can sell them or you can hold on to them. I mean, there's always, once again, it's not, I don't give investment advice, but, and it's not, you can always lose money in anything. Yeah. But I inherently believe that it's less likely when it's attached to a real estate asset. And so you'll be able to see that. So you buy in, and so say that the asset is $400,000. And we are going to allow 40,000 shares at $10 a share. So you can buy up to 9.8% of the shares. And so you can buy, if that's 10 shares for $100, 100 shares for 1,000, whatever, you get to decide.
So you're saying, wait, 9.8, are you saying, is it 0.2% like accounting for fees or?
No, 9.8, no, 9.8 is just the legal, as far as being compliant with the SEC. They don't allow any owner to own more than 9.8%.
Okay, got it. Okay, 9.8%, but that's not 9 point. Okay.
Yeah.
I'm
So
sorry.
in other words, if you were to go into, say, a home that's $400,000 that has 40,000 shares available, you can buy 9.8% of those shares available.
Got you.
But most people are looking that are getting into this are looking at this and they're going, I'm going to put in $500, maybe 1,000, 1,500 in each one or whatever, and they just add to them. Once again, that's where kind of the discipline comes in. It's just you buy into them, and then once they're fully funded, they'll go to the secondary market, and you can make your decision what you want to do there.
But I'm still confused on what the secondary market is.
So the secondary market just says, hey, this house was fully funded, and now you can transact in it. So it basically says everybody who bought into it, they sold all 40,000 shares. All 40,000 shares are sold, and now it's still the same app, right? You just hit marketplace, and then the home shows up there instead of on the primary. And then it says, hey, in your thing, you can say, I own 100 shares. I want to sell 15 of them.
Got you. I got you.
Or someone else has one that you missed out on, and maybe you're like, man, I'd like to own that home. There's 100 shares for sale. I'm going to go buy them.
Got you. Okay. Okay.
It's just a transfer of ownership into your portfolios.
I got it. Okay. That makes a lot of sense. Thank you for clarifying because.
Yeah. I wish, once again, it all comes down to, the adoption happens as people become more, they understand it more. And the complexity of the stock market is just that, right? You can buy, sell, you can do all these different things. These are complex. That's why a lot of people don't do it. But with Realbricks, it's very simple. You buy in, and when all the shares are gone, now you have the ability to do what you want.
Why would this be an attractive investment for your everyday nurse like me?
Because I think really what people have to realize is, look, you make an income, you have a lot of things against you, right? Number one, most people are on like a salary or hourly. They're stuck at just a threshold. You can basically determine your trajectory of income, right? But what you cannot predict is the trajectory of inflation. You can put predictions out there, but we don't know for sure where that all goes. So I always tell people, I'm like, it's like an escalator. If you want to go to the next level, you've got to get on the escalator. And how do you get on the escalator? You have to be disciplined to some degree, but you put some money into an asset. Not everybody has 40 or 50 or 60,000 extra dollars as a down payment for a rental. And then you go and get the rental, and then you got to fix everything that needs fixed. And then you've got to rent it out. And then what if somebody like misses a payment or what these things? Then you have to hire an attorney. You have to hire an attorney. And then you have to go through that. And then they could, and there's all these different things. So when you look at it from that perspective, we look at each property for various reasons, and we pick the ones that we think are in stable areas that we think are going to have continued growth, that are going to have low eviction rates, high job rates, cost of living makes sense, all these different things. And that's what we pick. And then we go, okay, let's offer this to people because we think it's a safer bet. But not everybody has the money to do that way. And not only that, what about your time? Your time is important. Time is money. If you're spending all your time trying to manage multiple assets every day, I know people think that it sounds fun to own people are like, oh, I got a portfolio of 100 homes. And you're like, wow, think how much money they're worth and all. It's like, how much money? Like, think about the headache. There's a lot that goes on. Taxes, all these different things that happen. Insurance, all these different things that continually go on and continually change. What doesn't change for most people is their income. What does change is all the external factors around them. Taxes go up, inflation goes up, cost of living goes up, on and on and on. So how are you going to hedge that? You need to get on the escalator. You need to put your money in something that has a trajectory to go up. Because the asset is going to increase. As long as the money printer is going, the asset is going to increase. Now, I know we had an incident, everyone goes, oh, the housing market collapsed in 2008 and everybody's
I was going to say, how do you deal with that?
You could go online and go to YouTube and find these people that talk about how the world's cut. But they've been talking about how the economy is going to collapse for 10 years, right? It's going to happen. This is the year. And it's like, what people got to realize is things have changed since 2008, right? Like the Fed put a lot of guidelines in, whether you like it or not, to stop that type of stuff from happening. And we were also at a time where adjustable rate mortgages were becoming massively overutilized.
Yeah.
And then, of course, adjustment in mortgage rates, and boom, there's your trigger. What we have today is we've had a very long path of low interest or no interest. And most people have gotten themselves in low interest mortgages. And so they're not necessarily going to hop up and be like, hey, I'm going to sell my house tomorrow because I want to take on this 6.5% mortgage interest rate, and I'm at a 3.5%. Like, it doesn't make any sense, right?
2.85.
So most people so a lot of people are going to sit on those. And even though people will still buy and stuff, that I don't see this massive shift that a lot of people call for. I do believe we will see shifts more localized. But I don't think we're going to see it on a national level like we did then. Is anything possible? Yeah, anything's possible. I think Rockefeller may have said that. Anything is possible. So anything may be possible. But I think the biggest thing for us is we're like, hey, you don't have to have tons of money. If you start with $100 and put $50, $100, $200 a paycheck, whatever works for you, on that escalator so you have it in something that is of value and that is tangible.
I thank you for addressing that, because I am one of those people who were traumatized by the housing market crash and have been very hesitant to get back into real estate, into home ownership, except for my primary residence. But like real estate as an investment class has been like a scary thing for me after losing so much. But I understand what you're saying. It's a different environment. And I like this platform because I like the way you guys put it. It democratizes home ownership. It makes it more accessible. That to be able to start with just $100, even if you don't fully understand it as an asset class, is one of the things that I like to encourage my people to do who are like new to investing, are just not very clear on investing, are very hesitant about investing. You start slow, but you get started and you learn along the way. I'm not going to tell you to take out a second mortgage and dump your money into a Bitcoin or something like that, like you were hearing a lot of people do a couple years ago. But yeah, $100 is something that most people can afford. Start there. Learn the platform, get familiar with what you're buying, how to transact, do the education along the way. But like you said, get on that escalator going up, because the only way to truly build wealth is to invest. And there are several forms of investing. I'm a big index fund girly, but I also believe that at least 5% of your portfolio should be dedicated to other kind of asset classes. And so I'm always looking for something new.
Yeah, no, it's great what you're doing, because you're educating people and getting them to realize that they have to get on. And I just use escalator because it's simple to build out in your mind. But I think what people have to realize is you have two options. You can be on the escalator down, or you can be on the escalator up. And inherently, everything does have risk. But one of the biggest risks is the willingness to not take risk. And this cuts more at the core of me, because I watched the '08 crisis go down, and it was ugly. At the time, I think I was 26, if I'm not mistaken. I had a business. I literally helped, I let people run up pretty large bills in my business at the time, because they lost their jobs. They literally did not have an income. And I was young, and I was like, man, I just 26 years old. I was like still very young to the world, the economy. And I watched that all play out. So I do understand people's fears of that. But what we got to remember is optimism is key, and the willingness to take small steps, which are small risks. You don't have to put everything into one thing, but you have to be willing to do it. And what I have realized is people who are willing to do it, whether they start off with 100 or 1,000 or 2,000 or whatever it is, I think the biggest, most beneficial piece is what it does is their confidence. Just for them to do it, take the steps, and they look back and they're like, man, I started off with 100 and I've got $3,000 in this portfolio now. Or whatever it is. I'm feeling like I'm actually on the escalator up instead of going down. And I know that's hard for a lot of people. That first step is difficult. But man, the greatest first step that I ever took in my life, looking back, was risk. It truly was. And when I started taking risk, I was younger. I guess maybe I'm more risk adverse than many, but that's okay. But not everything that I've done has panned out perfectly. But you've got to be willing to try. And sometimes what you'll realize is in trying, you will learn so much. And you probably know this, right?
Definitely.
Starting this podcast was a risk.
Yeah, I remember like delaying so long because I thought I needed to know like all of these things. And if it wasn't for a really good friend saying, just do it, I'll be your first guest, we'll figure it out along the way. And I just stumbled through it. And now it's just push a button. It's easy. Have all these things in place, automated. Boom, it's done. But it's that, like I said, that taking that first step to actually commit to doing it and just getting it done and learning along the way. Yes, you're going to make mistakes inevitably, right? But you learn in the process. And that's what I just tell people, that's my biggest like lesson for people, or the biggest thing I tell people is just take that first step. Yeah, I've learned a lot just in creating this platform in general. Learned a lot, but the lessons have been crazy exponential. The things that I've learned that I never would have thought I could have learned, the worlds I've been exposed to, I never could have imagined. So super grateful for just putting myself out there. But yeah, people live in fear and they don't. But I just choose to do things scared.
I think that's the way to growth and optimism, is through the fearful challenges that lay ahead. But once again, I've had 3 businesses. And when I decided to do this one, it was very much like, how can I impact on a greater scale and help others? It's easy to do things for dollars. It's harder to do them. I guess it's easy to do things for dollars, and if you're passionate, the dollars will come. But the idea is that you're willing to create things that benefit a larger group of people. And I think that's really what I've learned through my journey of taking risk. I know that this isn't talking about Realbricks, a platform, but it is a journey, right? It's a journey of risk. It's a journey of trying something new. And that's what Realbricks is offering. It's saying, hey, this is a journey for something new. There's not really any companies that are really doing this to this degree. So this is a journey for us. It's a journey for me. I'm taking immense risk to do this. But that's part of it. Prior, it was like I was looking at all these, involved in all these different asset classes and stuff that I thought were cool and unique and different. But, at the time, I also had a full-fledged apparel business that I started from the ground up, and it was an idea I started that back in 2016. In 2020 hit. And I was already formalizing how I was going to create this idea before that happened. And then 2020 hit, and it was like a trigger event. Everything nosedived. But then after that short nosedive, I manufactured everything in the U.S. The price for the fabric, the price for the label, it went so sky high. It was insane. And I said to my wife, I said, Jen, I've got to transition. I've got to transition because now's the time. Now's the time to look at what I was thinking about 7 months ago. And I need to follow, I need to make a move, because I do believe in years ahead, people are going to need this ability to, quote unquote, get on the escalator and start to go up, because I felt at the time things might be going in the reverse. Now, not where we're talking about the cost of living, the homes and all that stuff, but people's quality of life might be going in reverse.
Yeah.
And I knew it was going to be a very long trajectory to get there. But now it's real. It's holy cow. It's seemed like a blink of an eye. That's the crazy part. You know what I'm talking about.
Oh, definitely.
You probably look back from when you started and you're like, where did all the time go?
Exactly.
But that's when you know you're on the escalator up.
Yeah, definitely.
So,
can you explain the difference between Realbricks and, say, for example, a syndication deal?
yeah, so like syndication deals are more like where people come in and they come together on an asset. And I think syndication deals are hard to put together for a lot of people, because everybody, I mean, think about the most basic way is when you do a deal like that, it's like everybody has a different intent. Maybe their intent is to make money, right? We can all agree that their intent is to make money, is to make value. But when they go into it, they all have intents that don't necessarily, are not necessarily always shown in the beginning.
Mm-hmm.
And I think it's hard to put those together because you have to come together and pull that money together to create that deal to happen. Mm-hmm. And then, hey, what if Johnny decides early he doesn't want to deal with this? Mm-hmm. Or Tim's, I want to hold on to this deal. There's all these different things. And when you bring deals together like that, there's things that can go wrong. And when things go wrong in partnerships of any sort or business deals, they become expensive and they become potentially dangerous financially. Mm. The difference between that and what we're doing is everybody's on the same playing ground. Mm-hmm. You're coming in, you're all investing, whether it's $100 or $100,000, or we'll say $40,000 or whatever, if you hit that threshold, mm-hmm. You're on the same level playing field. That person who has more shares than you is not making the decision mm-hmm. over you. Mm-hmm. The managing partner, which is our company, makes the decision, and that's all disclosed. Hey, mm-hmm. we're going to collect this. We're shooting for this trajectory of rent. We're this, and it's all in the disclosures, and that's easily accessible on our platform. Like if you go in and you pick the asset, like mm-hmm. 123 Realbricks Avenue, you mm-hmm. click on it, you go down, you look at it. It'll have all these disclosures. You can look at all of it. It'll tell you exactly what we are going to do.
Yeah, I'm like, okay.
Yep, it's super simple. Obviously, disclosures, right? There's a lot of stuff in there, but it'll mm-hmm. tell you, hey, we're looking to hold on to the home for 5 to 7 years. We may sell it sooner if we feel the market's favorable, something to that degree. And if we do, everybody gets paid based off their ownership. Mm-hmm. But the key piece is you're not going to have these situations where people are battling over the deal, the house, what's going to happen, all these mm-hmm. things. It's just the nature of the beast, how it's done. And I think that's part of what the regulatory aspect of it, how the FCC wanted it done, where they've created these guidelines for a reason because of that exact situation where it's, hey, you're buying into this asset, you're going to own an interest in this asset, but you are not going to be the controlling member of this asset, mm-hmm. and you're not going to have voting rights and those things. And that's not, to be honest with you, it would be impossible to create something that is this frictionless if we did it that way.
Yeah, yeah.
And maybe the other piece of it is you're not going in with potentially a large amount of money too, right?
Yeah, like a lot of those deals, the minimums are like $550,000, $100,000. Exactly. Yeah.
So I have a very close friend of mine who his wife and him got involved in one of those deals, and it was for nursing home properties. Mm-hmm. And once again, it's not investment advice, it's just reality. They put in a little over $1 million 4 years ago. They are in legal battles up the wazoo right now. And they talked to him about a month ago about, Chris, if we recover $400,000 to $500,000 of our money out of this deal when everything's done, it will be a miracle.
I could have told you that wasn't a good investment, but nobody else.
But people do this, right? Because what happens is somebody knows somebody who has some money, who knows somebody, and they're like, hey, you want to get on this? This is the greatest thing that's ever happened. But those deals are so complex, and there's so much more that can go wrong, because it's like with what we do, it's very simple. It's, hey, this is the house. This is it. We're not going to let someone come in and cause a chaos in this deal. We're all going into this deal with the same understanding. That's it. It's very simple. And we can the great thing about it is we can execute on that because we're technically the managing partner. So as a company, so we're like, hey, we know the market's a good time to sell. We're going to sell. But on the other flip side of it, it doesn't really matter because you're going to have the ability to be in the secondary market anyway. So maybe you're like, hey, I want out of this now. Okay, great. You don't need anyone's approval. You just go swipe your phone.
Yeah.
You know what I mean? It's not like you're going to show up and I need to get my attorney and I need to get my money out and I need to do all these things. It's like you show up and you're like, hey, I own 1,000 shares and I'm selling 500 of them today. Swipe. No, it's not going to come back and say, sorry, you're not allowed to do this. It's
like when you do want to sell your shares, you just sell them. You don't have to wait for another person to buy them. You just can go ahead.
In the beginning, it'll be a little bit slower and it'll be mostly looking for other buyers. I would tell people once again, right? Look, you don't want to get on the escalator and then just hop off. Like I think it's a wise decision. Once again, I'm not giving advice here, but my thoughts are it's a wise decision to hold for a little while and let it grow.
Yeah, this is not day trading. This is investing.
Yeah, you're not going to see like massive day trading going on with this stuff. But I do believe there's going to be enough demand as we go that people are going to want to buy these, and if someone's offering them, people are going to want to buy them.
So I'm looking through a deal right now for a house in Nebraska, Omaha, which I know nothing about. And the offering amount is, I'm just looking through like how the deal is structured. The deal is totally funded by the shares that are sold because you don't take out a mortgage on it.
We buy the properties first. So there's no leverage on them, right? We buy them outright cash.
But do you wait until it's fully funded to buy it cash?
No.
Okay. So you already have the money sitting aside. You have already bought this property.
The company owns them. The deeds are in the company's name. They're insured, all that. It's all done.
Okay. See, that's great. Because I see the mortgage amount here and the interest rate. The mortgage amount is 0. The interest rate is 0. So why is that there?
Because that's just letting there's no leverage.
Okay. It's leveraged against anything else.
It's not a leveraged property. The reason that's there is because maybe down the road, you might look at like a it's tech build out for the future, right? Okay. We don't know what will change and won't change. But as of now, no, there's no leverage on any of them.
Okay, cool. So here you have the purchase price, which is $360,000. You didn't put any money in improvements. You have the closing costs here, your sourcing fees, and then it shows the total property cost. And then the thing I love to talk about is fees, because like I said, I'm an index fund girly and I always look at low fee investments. But can you break down what these fees represent? Your asset under management fees and then your monthly management fees. And are is that all encompassing of the fees, or is there more?
No, that's it. Every fee has to be listed. So our AUM fee is 0.75 of 1%. Okay. I mean, it's very small. Mm-hmm. And that's just an asset under management fee, right? There's costs involved with these assets, right? Because we have to put our time and effort into making sure that they're taking care of all these different things. But generally speaking, the fees are broken down. It's like we collect, an 8% fee of the rent structure. If we sell the property, we collect that fee. I don't foresee that happening too often because of the marketplace. It would make more sense for us to keep it. Mm-hmm. And we have that. And then there's a couple things, like there's a holding amount that we have in there. That's just, hey, look, the roof goes. We got to cover the cost of the, deductible for the roof. Mm-hmm. And it breaks down like what we've put in there, which is like insurance has been paid for, stuff like that. Mm-hmm. And then the property management fee is in there. But part of that is, well, obviously that fee, I think, is 8% total. 8%, but we have to manage the property in every aspect, right? Yeah. It's a lot of effort. Yeah. I think overall, like when you get down to it, our fees are not really that high because we're basing it more of, okay, we're taking a little bit from the rent and we're taking a little bit from the management of the property. So that way we can maintain and keep the property, because it's of value to the investor that the house stays of value, right? Yeah. And so that's really the way we look at it. I mean, you could look at other assets like funds and stuff, and you get into some of those fees. They take large amounts of profits. There's all these different things. We don't have anything like that in there. It's pretty simple structured, right? We look at it, we make some money off of that stuff. Not a lot.
I mean, but stock accounts, like what are they called? I'm drawing
like an advisor?
Yeah, the advisor could charge up to 2% of assets under management. And that's not even like a physical property that they're maintaining. It's basically to pay for their intellectual property or their platform that they're using or whatever to pad their pockets. But so in terms of fees, especially when it comes to a physical like structure, I don't think that it's really a lot. It seems,
but if you think about, so we'll take that one of those, the majority of those properties have gone up between 4.5% and 6.5% since purchase already in appreciation. And then we have the estimated return is 6%. If you do the math, if you combine both of them, you're up over 10%, right? Yeah. But if you think about the property is from a standpoint of you're holding on to the property for say 5 years. So On the marketplace, we'll have on the secondary market. So when they go to the secondary, the place where you can buy and sell them, the live feed data will show the value of the most current property. We can get that. We know by comps, we can get that information and it feeds in. And so you may have bought those shares at $10 when the house was $360,000. But 3 years from now, maybe that data feed is showing that that house is worth $440,000, $450,000. It will auto adjust the estimated value per share. So it would make sense. Then it's okay. I can, my shares were, I paid $10 for, now worth $18 or $16. I'm just throwing numbers out there per share. So not only were you collecting some of the rent money from it along the way, now you have an opportunity where regardless if the value of the home went up, the value of the home went up.
Yeah.
That is what's so insanely crazy about this, because that is really the piece that it's like solidifies the value through traditional markets, but in a way that can be utilized digitally and in real time, which is crazy, really.
Yeah. And while we're like doing like comparisons, how does this platform differ from like a Fundrise?
So like a Fundrise is generally speaking a lot. So Fundrise, I believe, offers a couple different things. So they offer maybe some Regulation A funds and then what we would call like Reg D funds. So Reg D is going to be like your accredited investor. So you've got to have a minimum net wealth. You've got to have all these things, right? And actually we have that built into our system now. So we can offer Reg Ds and we can verify people's accreditation literally in seconds. It's crazy, but we can do it. And so we just haven't offered those assets yet, but we've built out the tech to it.
Nice.
So Fundrise is going to be more like, but you're going to have individual assets when we do that. It's not going to be like, hey, you're putting your money into a fund. We're going to buy gas stations with this fund.
Yeah.
We have 25 gas stations and there's just a lot. It's almost like the idea of commingling. You're like commingling a bunch of assets into a bowl, right? And some assets are doing well in that bowl, some aren't. You don't know for sure exactly which one's a problem, which one's a good one, which one's this, and you don't get to individually pick. And I think that's the thing, like people, when we created this, we were like, okay, we don't only want to offer them value set because you have to create a value set for people to want it. But we also wanted to create it to where it's visual, usable. And frankly, maybe you're like bored at home and instead of surfing like Facebook, you're like, oh, I'm going to check out these properties and then swipe up. I mean, you literally swipe. It's done. I'm an investor. I'm done. Shows up in your portfolio, all of it. It's wild, the technology that we've created to do this.
Does your management company, is it just one singular management company that manages all the properties?
No, these first ones we've tied in with the management company locally. And the reason we've done that is so we pay them a percent, right? Out of that management fee, really what we end up paying most management companies is probably going to be in the realm of 5 to 6%, right? So we might take 2%. At the end of the day, we do it that way is we pick what we think is the most preferred management team to deal with it because we want to make sure that number one, the rentals are taken care of. We get the right renters, all these different things, right? Because that stuff is important. We have to preserve the value of the property.
Yeah.
That's a key fundamental piece. So we have that, but whoever's managing it is in contact with one of our team members monthly. We know what's going on with them. We know, and then that's connected to the rental fees. We know by looking in in the back end if rents are on time. We know all of that stuff. So,
do you have any rules when it comes to acquiring a property? Does it have to meet like the 2% rule? You know what I'm saying?
I think that the biggest key is, so we have a team of real estate experts that there's like, if you look on our team page, these are people that have been in this stuff for so long. And really, I give it to them where it's, hey, they go and find more or less markets that they see are going to have value in the future, right? That doesn't necessarily mean like a market. Maybe there's markets out there that have skyrocketed, right? They've just gone through the roof. And once again, it's the elevator ride up is great, unless maybe the elevator ride goes haywire, then things fly. And when they go up real fast, they can have a tendency to come down super fast as well. But so they're already looking at the different areas that we're going to be moving into currently. And so we'll have that stuff. Like, we send out a blog, we send out emails, we keep people informed. And as we go down that road, obviously we just launched a couple months ago. This has been a long road to get launched. Yeah. We will be giving people a lot more insight in those areas and what areas those are going to be, but it'll be national. They'll be all over. And I think that's what people ultimately are going to want in the long term.
So for a regular person, labor and delivery nurse like me that wants to get invested, what would that look like? I download the Realbricks app, and then what do I do?
Download the Realbricks app. Just have your idea, because once again, we're, just like a bank, we're regulated. Okay, but that's a good thing for the users because we're audited, right? That's important. So you download the app, you put your information in, you upload your ID. It literally, I'm not exaggerating, is less than 5-minute process. Pick a property, swipe up. You connect your bank account through Plaid. Everyone knows how to use Plaid Bank Connect. And you can literally invest right then and there within 5 minutes, and it'll show in your portfolio. It'll show everything. It'll keep track of everything. And your dividends will go in, and you'll just get a notice, hey, you got a dividend, and it'll be there.
Can you automate funding to this account? Can you automate your investments into this account yet?
So we are working on that currently.
Okay.
I'm glad you brought that up, because a lot of people are like, I want to put in every 2 weeks.
Yeah.
We are working on that. And I think we'll have that fully complete and operational Q2 2025.
Okay. Okay.
Yep.
Yeah, because like you said, a lot of people think like their paychecks. I want to make sure I put $100 every 2 weeks into this so that I have money available for whatever projects I want to buy. Right now, it's just currently you just spend money out of your bank account. There's no holding fund in there.
No.
Okay.
No.
But where do the dividends go?
Right into your portfolio.
Okay.
And then you can transfer them to your bank account the same way that
can you hold money into your portfolio,
You can leave it all in there, and you can use that to invest into other properties if you want to.
So you can put money directly. So you put the money into your portfolio.
You could put $1,000 in it today and be like, okay, I'm going to buy $400 today and wait a little. Yeah, absolutely. And if you don't want to do that, you can link your bank account, just do it directly. I want to buy this. It'll ask you how much, $500, swipe, done. It pulls it directly out of your bank.
Nice.
Yep.
But if I say, okay, yeah, I want to look around, I'm going to drop $1,000 into my portfolio, and then I'll spend that $1,000 across a couple of properties.
Yeah, exactly. And I think that's what people should do, really. It's like, when you think about it, it's like, just you're buying into different properties, and they're all going to be a little bit different, and spread it out, right? Like, once again, be disciplined, invest, but diversify into different ones.
And then my final questions, because I've been in the fintech space, and a lot of times, especially for startups, like, people are hesitant to get into startups because they don't often make it. So what happens with your funds in these projects if Realbricks fails?
Yep. So part of regulatory compliance for us is anytime we put up a property, the money goes into escrow. Okay. Right? Escrow holds the money until the threshold's met, and then it's released to our company. Done, right? Everyone's invested. It's all done, yada, yada. But if worst came to worst, which I don't foresee happening, we sell the assets. That money's still going to get returned back through to the investor. And that's why, when you think about this, so I'll use like FTX. Does everyone remember that situation where people were investing in that platform and they were what we call commingling funds, right? So escrows are set up so there's no commingling of funds. Escrows are set up through a third-party company, which is regulated also. But you don't ever see that because it's just very fluid. But there's all these things that happen in the background that it's like boom, boom, boom. And that is how we stay regulated. But essentially, they were commingling. They were spending money in all these different places. They were borrowing money from here and doing all these things. And at the end of the day, what assets were they investing in that had tangibility? That's the key component.
Yeah.
It takes a second to create, if you build a home, that home has tangible value.
Mm-hmm.
That if everything goes south, that home can still be sold. That ownership is still legally yours as interest. You legally have to be paid out on that interest. That's how it works. At the end of the day, that's why there's all these regulations
Yeah.
exist, because all these things have happened that unfortunately have created the need for all this regulation.
Yeah. Yeah. That's why we have FDIC insurance and all of those kind of things just for the money in our bank accounts. I just wanted to give people a little bit of reassurance because when navigating a different kind of investment, people don't know what protections they have. So I think that's important. Okay. So,
Yeah.
Chris, when people want to learn more about Realbricks and start into their first property, what are the steps that they take again?
Download the app or go to realbricks.com,
Mm-hmm.
set up an account. It takes 5 minutes, and just have the discipline to follow through and do it. And you're going to be amazed. You're going to be like, this is so easy.
It's so
easier than ordering a Frappuccino at Starbucks or some other place. Literally, it is literally that easy. People are going to be amazed at how easy this is to use. And a lot of people, I want to tell people too, the future is a lot of people are going to own real estate like in this fashion, right?
Mm-hmm.
You don't have to physically own all of it for you to be an investor,
Mm-hmm.
right?
Mm-hmm.
Great investors invest all over in different things. And that's what creates wealth. And so you just have to have the discipline to take the first step. But once you take the first step, you get on the escalator, every step after it just becomes, it just multiplies. If anyone has any questions, they can always reach out to support at Realbricks. We've got a chat bot that answers most questions. If it can't, it goes directly to one of our people. Mm-hmm. And we're here to help people whatever they need.
And I can attest to how easy the platform is to use. I haven't even signed in, but just in downloading the app, it took a couple seconds and I'm still able to, without even signing in, browse through the properties, look at all of the things that we talked about in this podcast. Check it out.
Yeah, no,
it takes a couple seconds. Just go check it out. See if it's for you. Ask the questions, learn along the way. Like I said, if you're interested, get started with a couple $100 and just see if it's something that works for you. And like I said, it's about taking those first steps and learning along the way. So I really appreciate what you're doing. I really appreciate you making real estate investing more accessible, because accessibility is everything when it comes to building wealth.
Yeah, absolutely. Yeah. Appreciate you having me on. Thank you.
Of course, Chris.